Lisa, do you hide in full faith in credit?
I think you definitely want to have some of your risk allocated to pure U.S. Treasuries right now. While we may have a little bit of a tactical bounce just given how much things have underperformed in credit recently, I think the path of least resistance from here is still tighter financial conditions. So I think you want to have a decent amount of liquidity in your portfolio.
Lisa, with that in mind, what's the risk that we still haven't fully realized? Is it the earnings story? What is it?
I think the market is, you guys were kind of talking about the correlations between bonds and equities, and I think it's really relevant here. The market is still gyrating between, is it a recession story or is it an inflation problem? Which one do we have? And as you see, I do think that the narrative will turn towards it's a growth problem. We're going to be heading into a U.S. recession. We're not quite there yet, which means bonds and equities, that those correlations can be a bit unstable, and I think you need a greater risk premium afforded to riskier assets, and credit would be a part of that. So for us, it's lower duration credit when we take it. I think the 3 to 5 year part of the market, credit market, investment grade looks attractive, reasonably attractive with the break evens there, but it's higher quality generally, it's liquidity, and it's not taking a whole lot of risk right now because I don't think we're in a spread compression environment for the foreseeable future.
How much volatility do you think we have to tolerate through the rest of this summer? Lisa, it's been amazing to me to see how much a narrative changes on a single data point within a data point. When did we ever used to talk about UMIT's reading of long-term US consumer inflation expectations? When did that move the bond market by 5-10 basis points in either direction, set the tone for a Fed that might go 50 or 75 at any given meeting? When did it come to this?
And that's the problem, right? Until you can figure out, or until the market can coalesce around where the risk-free rate belongs, how could we possibly decide on a path for riskier assets? You almost need to get some stability in that rate forecast before you can see any stability elsewhere. And I don't know how you want me to measure that volatility question, John, but I think it's more. I think the answer is more volatility, continued volatility, until we get some certainty that these inflation readings are going to start to trend downward.
So, Lisa, if someone were listening to this entire program, they would have heard Kristen Bitterly make the argument that you don't want to be in cash and that you need to be fully invested, because if you miss just a couple days, you miss an entire 8%, 10% return, and it really is the winning moment. What is your argument against that in your quest for liquidity?
I think it depends on who you're managing money for, what asset class you're managing, what your targets are, right? At the end of the day, we manage fixed income portfolios, and these are meant to be, in many ways, the ballast, the sleep at night portfolios for people. So we perhaps have a different risk budget and sort of target than Christian does. But yeah, you can't have all liquidity, which is why I suggest a decent portion of your exposure be allocated to some of these really high quality investment grade companies at the short end of the curve, where you can earn a 4.5% yield. Over the next couple of years, I think that's going to be a positive real return trade. It's going to take some time to get there, but I think we will be paid and rewarded for something like that, and it gives us the opportunity to sort of hide out and wait wait for better opportunities to emerge.
So, Lisa, when you say liquidity, how much is just pure cash?
Well, pure cash is hard if you're managing relative return portfolios, but I would say you want a decent portion, double-digit portion of treasury exposure across the curve. So we manage relative return, so we're benchmarked to the Barclays Agg in most portfolios, or many portfolios, and so that means we want a high-quality liquidity overweight, whether it be treasuries, agency mortgages, some combination thereof. Cash itself for us is hard. If you have an absolute return portfolio, then certainly cash is a better option.